Hey, Professor Mike. What are we learning today?
Hey there, everyone, and welcome back. It's me, Professor Mike, and now we're really in the thick of it. I hope you're all having a great time, made it through the first introductory sections, and now we're learning about some of the really fun things we get to do as accountants. And one of them is adjustments. So let's talk about accrued revenues and expenses. Now, accrueds, not the accrueds, don't want to get sued here, copyright. These are required where certain items have not yet been recorded in our records. So something has happened, but we don't yet know about it. So think of an expense that's not been paid for or recorded yet. And those are called accrued expenses, and revenues that have been earned but neither paid or recorded are accrued revenues. So those are the two really important factors. We haven't paid for or been paid for something. So for an expense, we haven't paid for it. For a revenue, we haven't been paid. And we also haven't recorded it. So for an accrual on the expense side, you might think, how about the interest charges on a bank account or a loan, something like that? So you have interest that's being charged. It's not reflected till the next month's statement, but because we need to match those expenses to the period in which they were used, we need to actually have those reflected in the period when they were used. And so when we get that statement, we need to accrue that back. Or wages for workers. So you've all worked, I'm sure, in some capacity. Some of you are working right now, maybe full-time. And you get paid after you work, but you actually earned that money earlier, you're paid later. So from your employer's perspective, you've actually earned that money. They owe it to you. You've worked. It's an expense that happened. So it doesn't matter when it's paid. It matters when you actually used it up. How about rent? So rent's due after the period in which you used it. Taxes, same kind of idea. And on the revenue side, think about maybe interest earned on a bank account that's paid in the next period. So in the same way that you could have a loan where your interest is paid later, where you're paying that interest later, the bank may pay you the interest for December in January. But you earned that interest in December, so you need to reflect that in your records so that that will show in your financial statements and you will be being honest with the people that are reading them. How about some fees earned for services provided that haven't been invoiced yet? So you've done some work, you haven't been paid, and you just haven't had time to invoice your customer. That could be an accrued revenue. Or maybe rent, the flip side. Instead of rent that you used and have to pay later, maybe you're renting something out and you're not getting paid till after the period in which it was rented. And this is the difference. Again, we've talked about this before, but the difference between accrual accounting, and I know many of you think accounting is accrual on its own, but we want to differentiate between that and cash accounting. So let's take a look at an example for accrued expenses. In December, which is going to be great, right? Skiing will be going again, hopefully heading through the holiday season. A company incurred $3,700 of utilities expense. The company had not yet received the bill at December 31st. So we want to record the entry for this accrued expense. Let's say you get the bill on January the 15th. Well, because you used up those utilities in December, you have to backdate it to December. So let's take a look at how we would record this. Again, it was utilities expense that we hadn't received the bill for yet, which means we hadn't paid it yet, and it hadn't been recorded because we didn't know what the amount would be. Let's bring up our old friend, the General Journal, and let's take a look at exactly how we would record that. Now, remembering we start step 1 for journals is what's the date? We're going to backdate this expense to December the 31st because in December is when those utilities were used. So our date then is going to be December 31st. Now we need to figure out the accounts that we're going to debit and credit. It was utilities expense. That's probably an account that we're going to debit or credit. It's an expense, so I know all of you know that we would debit it. But again, that's going to be one of the accounts. Now, what other account would be affected here? Have we paid it yet? I'm listening. You said no. No, we haven't, right? We didn't even know about it, so we haven't paid it yet. So it's an account that we haven't paid, it's unpaid, it's payable, an account payable. Yeah, in this case, it would probably be utilities payable. Okay? So we've got utilities expense and utilities payable. We're going to debit utilities expense because the expense is going up and that's what you do for expenses. And we're going to credit utilities payable because the liability is going up and that's what you do for liabilities. And here we are, our journal entry to report that accrued expense. How about an accrued revenue example? On December the 31st, $16,500 of consulting fees have been earned but have not yet been recorded or billed to the client. So we've done the work, but we haven't invoiced them yet, and we haven't recorded the transaction. The fees were collected on January the 15th of the following year. Record the adjusting entry. Oh, and as a bonus, we're also going to record the collection entry. So let's start with the adjusting entry and back to our old friend, the general journal. First thing we do is we enter the date. It's going to be December 31st. Remember, we're backdating this transaction so that it's reflected appropriately in the time that it happened. It was $16,500 of, and it was consulting fees, which is revenue. That's one of the accounts. Have we received cash yet? No. It's an account that's receivable to us, and we're going to call that an account receivable. Perfect. So we've got accounts receivable and consulting fees revenue. A receivable, which is an asset, and a revenue account. So the receivable is going up by $16,500, so we're going to debit it, absolutely. And we're going to credit the consulting fees revenue to the tune of $16,500. Now we said, as a bonus, we were going to do the second entry to collect that receivable on January the 15th. So let's think about what happened on January the 15th. A company owed us money. They paid us that money. There was an account that was receivable, and then we received it. What did we receive in exchange for that promise that they gave us? They promised to pay, and now they've paid. And they paid us. So our cash is going to go up, and we're going to give them that promise back effectively. Our receivable is going to go down. Now, both of those accounts are assets. So to debit an asset makes it go up, and to credit another asset makes it go down, which means we'll be back in, remember that balance, right? Let's stay in balance, we'll be back in balance within our accounting equation. In this case, we're going to debit cash and credit accounts receivable for the full amount of the receivable. Well, I hope this has helped. Bye.